Hi, I'm Sumaira Abidi, and I'm so excited to talk about the newest investment category, the SIF, or the Specialized Investment Fund. And we are very happy to announce the launch of the Magnum Hybrid Long Short Fund by SBI Mutual Fund. With me, I have the fund manager, Gaurav Mehta, and our head of equity, Dinesh Balachandran. So thank you very much to both of you. I know this is a very busy time, but Gaurav, I want to start with you first because the one thing that is really going to set our fund apart is the way you're looking at managing the derivatives to actually bring down the overall risk. Like when people think of derivatives, they think it's something very scary and very risky. So first, can you explain how exactly you're going to use it and how is it going to bring down the risk?
Right. I think interesting question, Sumaira, because derivatives can mean different things to different people. And one most common belief is that derivatives are used for speculation. They are risky instruments, and therefore SIF must be an aggressive product. I think derivatives can, yes, be used to enhance risk, but they can also be used to mitigate risk. And in this product, that's exactly what we're trying to do. We're trying to use derivatives to reduce risk or to mitigate risk, and as a result what we're striving for is a very conservative product positioning. So essentially the core of this strategy is to invest about 25 to 35% in debt, 65 to 75% in equity, and up to 10% in REITs or InvITs. And within equity we are very heavily using derivatives, but essentially what we're trying to do is to A, generate some income through option strategies, and B, reduce variability in returns. So think of a situation where you own the stock, you sell an out of the money call option, in turn you get some premium, but you also lose upside beyond a certain point, so you cap your upsides. Now simultaneously also assume that you are buying a put option a little further away, so that on a net basis, while you pay for that premium, on a net basis you are still earning some premium income. Now the payoff that you have is, yes, through selling the call you have capped your upside, but buying a put you have also limited your downside. So in a way you have reduced variability in returns, and on a net basis if you're earning premium income, that also gives you some sort of a source of income. I think that's exactly what we are going to do in the equity part of this fund, which is that limit the variability in returns and strive for some premium income on a regular basis.
So you're saying that it will have more consistent return in that sense?
Exactly, that's the attempt. You are happy to let go of significant upsides as you see typically in a runaway equity market, but the benefit that you're trying to achieve is also reduce downside in significant market falls, and as a result reduce variability in returns.
So it's not a party fund, it's a sleep easy kind of fund, right? All right. The other thing is that, there is this whole talk of how you have unhedged derivatives which can be used. Is that something you intend to use? And I mean, unhedged again makes it sound riskier than it should. How is it going to work?
So I think we will have 65% in equity assets at all point in time, 25% minimum in debt. So that takes it to 90% between these two. So the remaining 10% leeway is something that we can and we will at points use to express our views on unhedged short positions. But there again, I think our attempt will be to work with a band of variability and limit variability on either sides. And if you're short something, the simplest way to reduce variability is first limit your risk. When you're short, the risk is on the upside, so you buy a call option to limit your risk, but at the same time if you also want to earn some premium income, you sell a put against it, and that in a way caps your profits, caps your losses, you earn some stable premium income. So it's exactly the opposite of the trade that I explained on the long side. So through that covered equity exposure, we can and we will at points use the flexibility to go short as well.
Okay. Bala, I'm sure a lot of people have already asked you this, but this is again in the hybrid category where we already have two big funds, which is on the mutual fund side, which is the balanced advantage and the multi-asset allocation. So how is it going to differ?
Right. So when you think about the whole premise of hybrid funds, the idea is investors want more than FD returns, but they often do not want the volatility that you see with pure equity funds. right? So the hybrid essentially attempts to fill that in-between solution where you're okay taking on some risk. You want return more than FD, but you don't want the volatility, and so you're willing to accept a lower return compared to a pure equity fund. So when I think about multi-asset allocation fund or balanced advantage fund, they are essentially in the in-between bucket. But what you realize, even the in-between bucket is quite vast. Even within that, you can think about risk return profile being more conservative or less conservative. So when I think about the hybrid spectrum, within that, I put the SIF within the conservative sort of end of the spectrum. So what it means is that when I think about a multi-asset allocation fund or a balanced advantage fund, the return could be better than what we might see in SIF, but the risk profile is definitely going to be much higher. So for us, the SIF product is a more conservative product, whereas Gaurav mentioned, the risk return profile is going to be within a very narrow band. And that essentially makes it very convenient for a certain class of investors, where they might not even be okay with the volatility that you might see in a balanced advantage fund or a multi-asset allocation fund.
Okay, so one is the investors who are very, very conservative, but the SIF, because the minimum investment amount is 10 lakhs, so one imagines that it's also the HNI, ultra HNI. Why is it an appeal for that section of investors, and what should be the minimum holding period that an investor should stay invested?
Right. So when you look at it, right, there are so many investors who used to invest in debt mutual funds a few years ago, particularly within the HNI segment. But then the change in taxation made that entire category not so attractive, because post-tax, then the returns became quite subpar, right? Now you have a lot of investors who are investing in arbitrage fund, where again you're essentially getting something slightly better than liquid fund return, but you essentially enjoy equity taxation. We can appeal to both these categories with this SIF product, where the idea is that I can essentially get a debt fund plus kind of return, but with equity taxation. And so I should definitely be able to give returns better than arbitrage fund over a longer time frame, again with the same equity taxation. So it makes it very interesting for investors who are already trying to sort of get to that kind of solution. It's just that debt mutual fund taxation change has made it so unattractive that there is a void out there, and that is the void that we are attempting to fill with this particular product. So now when you think about holding period, it's equity taxation, which means that logically speaking, someone should be in it for at least a minimum 12 months period, so that you can take advantage of long-term capital gain as opposed to short-term capital gain. This product is very liquid, but our thought process is that someone should be in it for at least a minimum 12 to 24 month holding period, so that you can take advantage of the long-term capital gains essentially.
Okay, so it's like a debt fund on steroids?
I would say that it is a debt fund plus it is not going to be dramatically higher, but the risk profile also is going to be quite controlled, but with much better equity taxation. So I think it logically speaking should appeal to people who essentially want part of their portfolio to grow at rates better than FD returns. Obviously, is it completely risk-free? No. But the risk profile is quite controlled, and post-tax, it becomes a very interesting proposition essentially.
All right, Pala, Gaurav, thank you very much to both of you, and all the very best, Gaurav. We wish you every success with this fund.
Thank you.
Thank you so much, Sumaira.
Investments in specialized investment fund involves relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.